Thank you for your time today. We're going to start with TrustWorks. And what we're going to do is something similar to last week when we talked about CorpWorks. Namely, we'll just focus on the things that make TrustWorks unique. Things like portfolios, rental properties, businesses, and so on are essentially common across VisionWorks, CorpWorks, and TrustWorks. So the first thing we want to look at is just setting up a trust. Now, when you first run TrustWorks, there'll be a default first party, and what you'll need to do is click the edit button and then complete the different tabs. Once you've done that, then you can add any number of trusts to a plan, and you do so, of course, by clicking the add button. And I want you to notice that you're given a choice. Is it a testamentary trust? And if so, what type of testamentary trust? So you open the list, look at the various types. Is it an inter vivos trust? Select it, look at the different types. And notice also a help button, which will then give you some background on the types of trusts and some of their features. So you can see spousal trust, common law trust, family trust, and so on. And again, if we have a look, you can see the types of inter vivos trusts. And I just want to scroll down to give you an example. So with an alter ego trust, the settlor must be 65 years of age or older to set that trust up. Now, if Bill, for example, is currently 62, that doesn't mean you can't set the trust up in TrustWorks. All it means is that when you go to put in the creation date of the trust, it has to be a few years from now when Bill has finally turned 65. So let's have a look then at importing settlors and beneficiaries. In some trusts, the beneficiaries of the trust cannot be the settlor. In this case, in order to put in a settlor, you can literally add anybody. So what we'll just do is we'll click edit. So I could go to add settlor, create, enter new, and just call that person settlor. For our purposes in getting the trust set up, we're not focusing on all the legal documents that would be required. We just need to get the trust set up, so we can just name them settlor. In other cases, of course, for example, that alter ego trust that Bill's going to set up in a few years when he's 65, then what we would be doing is clicking import from VisionWorks, importing Bill Smith, because in this case, an alter ego trust, Bill is both the settlor and the beneficiary. So in some cases, you will be importing settlors from VisionWorks. If we go to the beneficiaries tab, again, you can see import from VisionWorks or import from CorpWorks. So we have the ability then to import the different beneficiaries. And once again, and this is similar to CorpWorks when we're setting up, who the shareholders are. If I click the add button, and I'm just going to select enter new for now, and then click OK, you can see if I want to add a beneficiary that besides the person's name, what we'll also be doing is putting in their beneficial interest. And notice we would be putting in their date of birth as well. One of the things that is important then is when you click the add button, be aware of what the selection is. Is this a person you're adding, or is it, for example, a corporation? So we'll need to open that list, select corporation, and then when I click enter new, for example, so you can see the fields, you'll notice that the fields here are different because we're talking about a corporation, we're not talking about an individual. I'm also going to recommend to you that when you set these trusts up, even though they're discretionary and the beneficiaries can change over time, I'm still going to recommend that you put in what the existing income interest in the trust is right now. And the reason for that is because on Bill's death, his interest in the trust isn't going to disappear. So right now, if the beneficiaries are Bill 40, Sue 40, and Bill Smith Jr. 40, then what will happen on Bill's death is that his 40% income interest will be transferred to the other beneficiaries. So in this case, we can see that Sue is going to get 80% of the income of the trust, her 40% plus the 40% that she would take over, if you will, from Bill. So we need to be able to enter that so that when we do the import into VisionWorks, if there's income being paid out from the trust, we'll see both Bill Sue, or we'll see Bill Sue and Bill Jr. receiving that income. But on Bill's death, Sue will receive not only her income, but she will then receive the income that Bill did through to his life expectancy. So it's very important that we put in those beneficial interests so that we can properly control what happens in VisionWorks after the death of one of the parties. The other thing that I just want to point out is that you also will need to put in the capital beneficiaries. They can be different, of course, from the income beneficiaries. So if you want the value of the trust to show up in VisionWorks as an asset, it's not the income beneficiaries and their interests that matter. It's the capital beneficiaries and their interests that matter. So you need to set up the capital beneficiaries if you want to see that imported. Let's go to the general tab, very straightforward, name the trust, what type is it, et cetera, et cetera. And then what I want you to notice is that once you put in the creation date, automatically the deemed disposition date will be entered, in this case, 21 years later. And the division date is the date of death of the longest lived of the beneficiaries. So in this case, that would be Bill Jr. So once all of those tabs have been completed, then if you go to the map tab, you'll see, of course, that TrustWorks builds a map just as VisionWorks does and CorpWorks does. So now that we've set the trust up, just the About page, we don't need to yet enter any of the details as far as the assets of the trust or whatever the case might be. What we need to do then is we need to link the trust to VisionWorks. So there are a couple of ways that we can do that. If we go to VisionWorks, go to the import-export page, then we can import the trust. And when we import the trust, in this case, the Smith family trust, I'm not going to import the spousal trust right now, but when we import the trust, then it becomes available for a variety of features, including transferring assets to a trust. As a matter of fact, let's just go back for a moment and we'll also import the Sue Smith spousal trust. So once those have been imported, then we can start talking about, to whom or what assets are we going to transfer to a trust. And there are basically two approaches. One is transferring assets to a testamentary trust. So to do that, we'll go to the will page. And you can see right now, we've got the beneficiary as being Sue. But having set the trusts up, the family trust and the Sue Smith spousal trust in TrustWorks, now those trusts are available now that we've imported them into VisionWorks so that we can make selections. So you can see now, for example, that instead of transferring the cottage to Bill Jr. on Bill's death, which would attract all kinds of tax and so on, we now have the option of transferring the cottage to the Sue Smith spousal trust. Obviously, testamentary trusts are available on the will page, so that raises the question, what about inter vivos trusts? Where are they available? And what you can see if we go to entries and we go to any asset, let's stay with the cottage. What we can do is go to the buy sell panel, go to the sell, give, donate, select the action list. And when we select transfer to inter vivos trust, you can see now that the Smith family trust is available for us to transfer the cottage to. So it would just be a matter of putting in a date. So again, there are two ways that we can deal with assets to transfer them to a trust. One is on the will page, testamentary trust. The other is an option for an entry on its buy sell panel. So, keep it, sell it, give it away, donate it, transfer it to a corporation, or transfer it to a trust that we've already imported. I'm just going to leave this as keep for now. So let's have a look then at residue beneficiaries. So we've talked in terms of setting up a trust, transferring assets to it, testamentary, inter vivos. But then we need to talk about what happens on the deemed disposition date or division date of the trust to the assets that are in that trust. So we go to residue beneficiaries, and you can see here that what we need to do is just select the beneficiary entry in the tree view for any asset, and then go over to the beneficiary list, select any beneficiary we wish. In this case, we're going to select Bill Jr. And then we have the opportunity to either distribute an asset from the trust to a beneficiary 1 day before the deemed disposition date, meaning that we are going to avoid the tax that would happen based on the 21-year rule, or we could keep that asset and then distribute it on, to someone on Bill Jr.'s life expectancy. I want to just flip back to the entries tab and go to net cash, because in this case, we've said we're going to distribute that asset on Bill Jr.'s death. So I want you to notice here that the trust was set up in 2010. So the 21-year rule is 2031, and then 21 years after that is 2052, and 21 years after that is 2073. So you'll actually notice that the net cash flow is a little bit less in those 3 years than in all the other years. So if we drill into 2031 and just look at the basic tax return, not the detailed one, what you'll see is that there's a deemed disposition calculation taking place that year. And that's what's adding the additional tax, and therefore the additional cash use. In this Form 1055, the deemed disposition date, what happens is the value of all assets are marked up to the then calculated value of an asset. For example, a rental property has increased in value over time. And so we're marking it up to that value, that new fair market value. And then what's happening in the background is that TrustWorks is calculating the deemed disposition, not an actual disposition, the deemed disposition, in order to determine the taxes that would be owed on that rental property as of December 31, 2031. Let's go down now to solutions. The layout, again, is the same as VisionWorks, CorpWorks, and TrustWorks. Above the graph on the right, we have the different buttons, so we can switch to spreadsheet mode, expand that to a full screen. We can switch back to the graphical mode and so on. And then below the tabs or the graphs, we have the different tabs: net worth, assets minus liabilities, net cash flow. And I also want you to notice allocations. This is where we'll actually see the value of the income allocations being paid out. And again, that's available so you can see changes over time. And this is, relatively similar to that tab in CorpWorks, which is the tab that shows you the different shareholdings at different points in time, the capitalization tab, and how those shareholdings can change over time. So in this case, it's a matter of how the allocations can change over time. So let's have a look at tactics. There really aren't a lot of tactics that are available for a trust. Again, if there were an insurance policy with a cash surrender value, then you'd be able to take out a bank loan or policy loan, for example. And also, if there were things like charitable donations or whatever, you can choose when you want to claim them, if you want to claim them in the year made, or if you want to deselect claim all and enter them in specific years because of some anticipated unusually large income amount. The key really is looking at distribution. So the terminology in a corporation is to declare and pay dividends. The terminology in a trust is to allocate and distribute income. While the terminology changes, in effect, the way this is done in TrustWorks is essentially identical to how it's done in VisionWorks, meaning that we have both the ability to put in manual entries and auto withdrawals. And you'll notice, of course, that the types of income that can be distributed could be CDA dividends. If the trust owns shares of a private corporation, that corporation could pay CDA dividends to the trust, making them available for distribution to the beneficiaries. The same thing, ordinary dividends from a corporation to a trust. And again, a corporation could pay eligible dividends to a trust in addition to any dividends that the trust might earn on public company shares. In this particular case, we have other income, and this just arises from a business that's in the trust. So you can see that the different types of income are going into different pots, so to speak. In the case of capital gains, a distribution of capital gains can either be all capital gains earned in a year or just taxable capital gains. So if you distribute taxable capital gains, then at the current rate, half of the capital gains would be retained by the trust, and any income that's not distributed by the trust is added to the capital of the trust the following year. That would be after taxes, of course. In the case of the non-taxable portion of capital gains, it's just added to the capital. So we have the ability then to go in and, for instance, indicate, what we want to distribute. Again, we could go in and edit the number in the table, index it, etc. But we also have the ability to do auto withdrawals. And I want to speak a little bit about this. You can see it's selected. There are two ways of doing this. And again, similar to CorpWorks, what income is it that we want to distribute? Do we want to distribute the CDA dividends, eligible, ordinary? We can change the order in the list and so on. One way that we can auto withdraw, and this is fairly common, we might, for example, have Bill Jr. attending university. So we might want to put in some number which we could index. And let's just say we want to put that expense in for the next several years. I'll just run it down to 2027, and then I'll reset it to 0. So what we're seeing now is that for the next 5 years, Bill Jr. is going to be receiving a dollar amount, which is going to be indexed every year. What we want to do with the balance of the income, because we want to pay it out, is not paying necessarily a dollar amount out to Bill and Sue, but rather we can select a percentage. So we can have, let's say, 50-50. And then what's going to happen is that in the years when we're paying a fixed dollar amount out to Bill Jr., then whatever other income is left over is going to be split 50-50 between Sue and Bill. But again, you'll see that we can repeat this to the end of the table. So what's going to happen is, why aren't you? There we go. What's going to happen then is that the leftover amount, so to speak, in the first 5 years will be split 50-50. But once we can stop paying out Bill Jr. that fixed dollar amount, then all income will continue on being split 50-50. So again, this is relatively common for family trusts where they're being used to pay certain expenses, let's say for certain children at certain periods of time. And then what's left over is going to be split amongst the main beneficiaries, the parents in this case. The second approach that we can take to auto withdrawals is similar to what we've seen in CorpWorks, namely sending a message to VisionWorks saying, how much income do you need in a year in order to top up your bank account so that you receive the distribution from the trust that you require. And so CorpWorks sends a message to the linked VisionWorks account, which then sends a message back to TrustWorks saying, this is what I need. TrustWorks then makes the distribution. VisionWorks sends a message back saying, okay, but not quite, because depending on the type of distribution, I need to have you gross that up because I have to pay taxes on it. So the two speak back and forth to each other in order to figure all that out. But what's most interesting is not necessarily the direct link from TrustWorks to VisionWorks, but rather the link of CorpWorks to TrustWorks to VisionWorks. So if in this file, for instance, the Smith Family Trust owned the shares, let's say, of ABC, then TrustWorks is sending a message to VisionWorks, how much income do you need? VisionWorks is sending a message back to TrustWorks, this is what I require. TrustWorks then sends a message out to the linked CorpWorks account saying, please pay me dividends in this amount, which it then distributes out to VisionWorks, and VisionWorks says, sorry, not quite enough, I have to pay tax on those dividends. So TrustWorks sends a message back to CorpWorks saying, you'll have to pay me more because in VisionWorks, there's a tax hit on these distributions. So that's a fairly complex routine, but it's one that is going to save you absolutely huge amounts of time when you're linking corporations that are owned by trusts to the beneficiaries, and you're looking at the flow of income through that complete cycle. The one final thing that I just want to look at is going down to do reports. And I just want to remind you that in VisionWorks, CorpWorks, and TrustWorks, if we go to report options, and I'm going to switch to the worksheet mode, I don't want the full summary report, that you can select, in this case, the T3 or the T3 plus supporting schedules. So now if we go in and click OK, and we have selected cash uses in the T3, then when we click print preview, we're going to build a tax return. And you can see in this case, we built it for 2022. So we can see the T3, and once it's loaded, we'll cycle through and have a look at some of the supporting schedules, which of course are used to populate specific lines in the T3. So as we cycle past, we can see capital gains Schedule 1A, dispositions of capital property Schedule 1, and so on. So what I want to do is just go down to report options, and I want to go out into the future and select 2031, which is the deemed disposition, which is the deemed disposition date for the Smith Family Trust. And now when we click print preview, we're now looking at the tax return for 2031. Just as we saw when we had a look at the little summary report summary T3 once this populates. We'll be able to see the Form 1055 calculation, the $25,000. So now we can cycle through and look at the 1055 and go down through it and see what's being transferred to the T3. You can see it here. So those are the things that I wanted to cover today, just a very high level look. The most important thing is, in order to work with a trust and VisionWorks or CorpWorks, given that the assets are going to be transferred, let's say from VisionWorks to TrustWorks, either as a testamentary trust on someone's death or as an vivos trust, then what we need to do is we need to first set up the trust in TrustWorks in order to make it available to be imported into VisionWorks, so that we can then say, you know, what are we going to do with these different assets? On Bill's death, is the cottage going to the Sue Smith Spousal Trust, for example, or is the cottage going, for example, to a family trust? By the way, if you do enter a family trust, an inter vivos trust, as an asset that's to be transferred to a trust, then an inter vivos trust, then what happens is that is no longer available to be transferred to a testamentary trust, because we've already transferred the assets to the inter vivos trust. So it's simply the assets no longer available for the testamentary trust. So those are the things that I wanted to cover today. The most important thing is to get everything linked, because once it's linked and you then enter the different assets, then everything is more or less going to take care of itself, other than the decision that you make around the distributions of the different types of income. So thank you very much. We'll post this as a video. We will resume our webinar series on Friday, September 9th. What we're preparing is a whole series of emails that will go out weekly, will be supported by a short weekly webinar. And we're going to be looking at different features that are available to you that you may not use. And we're going to explain why in the whole life planning approach they fit in and can offer a real advantage. We'll start with the ideal planning candidate software. It will help you understand what kind of plan most suits a client within the context of your business model. Some people are just not suited to doing a full financial plan, and if you approach them on that basis, it's going to be, you know, a real slog to get information from them and so on. The ideal planning candidate software will indicate that these people are more suited to doing just a very basic retirement plan. So it's going to help you in the sense that you won't be wasting time trying to deliver a certain type of plan to a client. And then similarly, if you're approaching somebody on a retirement plan basis, it'll tell you these people really want, you know, something that's far more thorough. So that's September 9th. I hope you have a great rest of the summer and look forward to meeting up with you again in September. Thanks for your time.